Good morning children, welcome back to macroeconomics class. In the last class, we were discussing about the circular flow of income and the different methods for calculating national income. Today, we will discuss some more topics related to national income accounting. Let's move to the topic. Children, we can check what is gross investment and net investment once again. Gross investment is the total expenditure that is made for buying capital goods over a time period without accounting for depreciation. In gross investment, we are not calculating or we are not considering the depreciation. Or in other words, gross investment is the amount that a company has invested in a particular assets or the business as a whole without considering its depreciation. But in the net investment, it is the actual addition that is made to the capital stock in a given period. Net investment takes into account the depreciation and is calculated by subtracting the depreciation from gross investment. So we will get the net investment by deducting the depreciation from gross investment. So how can we define gross investment and net investment and how it's calculated? Gross investment is the total expenditure done for buying capital goods or adding to the capital stock over a time period without counting depreciation. But the net investment is the actual expenditure done for addition to the capital stock or buying capital goods over a time period. Take into consideration the impact of depreciation. So the gross investment is calculated by calculating the total expenditure done on acquiring capital goods, whereas net investment is calculated by subtracting depreciation from the gross investment. So the net investment is equal to gross investment minus depreciation. Now let's have a look at the term inventory. Inventory is the stock of unsold finished goods or semi-finished goods or raw materials which a firm carries from one year to the next year is called inventory. Inventory is a stock variable. Change in inventories may be planned or unplanned. In case of an unexpected fall in sales, the firm will have unsold stock of goods which is not anticipated. Hence, there will be unplanned accumulation of inventories. In the opposite case, where there is an unexpected rise in the sales, there will be unplanned decumulation of inventories. Children, this inventory is a unsold stock of finished goods. That's it. The inventory is absolutely depend on the sales of that firm. So if there is an fall, the unexpected fall in sales, there will be more stock of unsold goods. So that is a stage of unplanned accumulation of inventory because they are accumulating the goods. So there will be a stage of accumulation of inventories. So that is the unplanned accumulation of inventories. But on the contrary, if there is an increase in the sales, the item will be sold out quickly, right? And there will be a less stock in the firm. So that is the condition of unplanned decumulation of inventories. So I hope you got the difference between this unplanned accumulation of inventories and unplanned decumulation of inventories. Children, now we are moving to discuss about some most important concepts of this lesson. That is gross domestic product, gross national product GNP, net national product NNP, and personal income, disposable incomes, etc. What is GDP? GDP stands for gross domestic product. GDP stands for gross domestic product. It is the value of all final goods and services produced inside of a nation during 1 year. So, if he talks about Indian GDP, we should consider whatever has been produced in India or whatever produced within the boundaries of India. So but the products produced outside India won't be calculated or counted in the calculation of GDP. The only point is the goods must be produced inside the boundary of a nation. So that is the gross domestic product. There are two approaches for calculating GDP, that is the expenditure approach and the income approach. GDP can be computed in two ways, the expenditure approach and the income approach. What is expenditure approach? A method of computing GDP that measures the amount spent on all final goods during a given period. But in income approach, that is a method of computing GDP that measures the income, wages, rents, interest and profits received by all factors of production in producing final goods. These two approaches includes furthermore categories or classifications. So you have to study that categories also. Then only you will get an idea to calculate the GDP through this way. Okay children, so that also we can learn now. Children, so there are two different approaches for calculating GDP, or there are different two ways to calculate GDP. Which are they? The expenditure approach and the income approach. So what is expenditure approach? The expenditure approach calculates GDP by adding together the four components of spending. The equation is in the form of GDP is equal to C plus I plus G plus the difference between X minus M. Now let's check what these equations meant. In the expenditure approach, it's also classified, or there are four different categories coming under this expenditure approach. That is the personal consumption expenditure, it denotes C, and the gross private domestic investment. The next is government consumption and gross investment, it denotes G, and finally the net exports. Now let's check each and every category in detail. What is the personal consumption expenditure? That is the household spending on consumer goods. That means whatever the amount spent by household on consumer goods, that is personal consumption expenditure. The next one is gross private domestic investment, it denotes I. Here it explains whatever amount spent on new capital by firms and household. The new capitals in the form of plants, equipments, inventory and new residential structures. So all these are, that means whatever spent by firms and household for purchase of new capital. This is coming under gross private domestic investment and it denotes I. The next category is government consumption and expenditure, it denotes G. So this is the consumption of government and gross investment. And the last is net export. We are exporting the goods to foreign countries and also we are importing from foreign countries. So net export means the difference between these export and import. So these are the four categories of expenditure approach. So finally, as per this expenditure approach, the GDP is calculating by summing up of all these four categories. That means GDP is equal to C plus I plus G plus the difference between X minus M. That is C stands for consumption expenditure, I stands for investment, G stands for government expenditure and the difference between X minus difference between export and import, that means X minus M. So this is a equation of calculating GDP as per expenditure approach. Children, just now you learned there are four categories coming under expenditure method. The first one is personal consumption expenditure. This personal consumption expenditure also subdivided into different groups. Which are they? Personal consumption expenditure, it denotes C, are expenditures by consumers on the following: durable goods, non-durable goods and services. What are durable goods? Goods that last a relatively long time, such as cars and household appliances. And the second division is non-durable goods. Goods that are used up fairly quickly, such as food and clothing. This food and clothing are non-durable goods. And the last one is services, the things that we buy that do not involve the production of physical things such as legal and medical services and education. So these are the three subdivisions which are coming under personal consumption expenditure. Same as there are subdivisions in gross private domestic investment too. What are they? Investment refers to the purchase of new capital. So the following are the different subdivisions coming under gross private domestic investment. First one, investment refers to the purchase of new capital Total investment by the private sector is called gross private domestic investment. It includes the purchase of new housing, plants, equipments and inventory by the private sector. The next subdivision of gross private domestic investment is non-residential investment. It includes expenditures by firms or machines, tools, plants and so on. Next is residential investment. It includes the expenditures by households and firms on new houses and apartments and buildings. Next is change in inventories. It computes the amount by which firms' inventories change during a given period. Inventories are the goods that firms produce now but intend to sell later. The next is net exports. Net exports is the difference between export and import. Government consumption and gross investment. It is the consumption of government and gross investment. It counts the expenditures by federal, state and local governments for final goods and services. So these are the different classifications and explanations of expenditure method for calculating GDP. The next we are going to income approach. The income approach. As per income approach, national income is the total income earned by the factors of production owned by a country's citizen. The income approach to GDP breaks down the GDP into 4 components. GDP equals national income plus depreciation plus net factor payments to the rest of the world and plus others. So these are all about the calculation of GDP through different 2 approaches, that is expenditure approach and income approach. Children, I hope you understood about the 2 different approaches, how the calculation of GDP is going under through 2 different approaches, that is expenditure approach and income approach. Children, now you have to learn about personal income, personal disposable income PDI and national disposable income NDI. So what is personal income? Personal income is the income actually received by the individual household from all the sources in the form of current transfer payments and factor incomes. So personal income is the actual income their individual household received from all the sources including current transfer payment and factor income. So the personal income can expressed as personal income is equal to personal income PI is equal to private income minus undistributed profits minus corporate tax. What is undistributed profits? Undistributed profits is the earning of corporation which is not paid to the investors in the form of dividend, that is undistributed profit. So we'll get a personal income. Personal income is equal to private income minus undistributed profits minus corporate tax. So what is a private income? Private income is the income of private sector obtained from any source, productive or otherwise, and it includes transfer income also. Transfer income you already learned in the last session itself. Transfer income means it includes gifts, scholarships, and during this natural calamity time we are getting funds from outside countries, foreign countries, that also included this transfer payment. So private income includes the income of private sector obtained. The private income is the income of private sector obtained from any source, productive or otherwise, and it includes transfer income also. That is a private income. Now let's see what is personal disposable income, that is PDI. Personal disposable income. It is the amount which is actually available to the households and the non-corporate businesses after the deduction of all tax obligations to the government. So we'll get a personal income, personal disposable income. PDI, personal disposable income, PDI is equal to personal income minus direct personal taxes minus miscellaneous receipts of the government. So these are all about personal income, private income and personal disposable income. Now let's check what is national disposable income. National disposable income NDI. National disposable income, it refers or it is defined as the maximum the country can afford to spend on consumption goods or services during an accounting year without having to finance its expenditure by disposing its asset or increasing its liabilities. That means, children, this NDI, National Disposable Income, denotes simply it means the amount of a country can spend on consumption goods. I repeat, the amount a country can spend on consumption goods and services without increasing their liabilities or selling any of their assets. That is the national disposable income. National disposable income means the amount a country can spend on consumption goods and services without increasing their liabilities or selling any of their assets. That is national disposable income. National disposable income can be gross or net. Net national disposable income is equal to net national product at factor cost plus net indirect taxes plus net current transfers. And the gross national disposable income is equal to net national disposable income plus depreciation. Children, now let's learn about GDP deflator. GDP deflator. Before that, you have to be familiar with the terms nominal GDP and real GDP, because this GDP reflator, it shows the ratio between nominal GDP and real GDP. So we have to understand what is nominal GDP first. Nominal GDP is GDP measured in current dollars or the current prices we pay for things. Nominal GDP includes all the components of GDP valued at their current prices. When a variable is measured in current dollars, it is described in nominal terms. That means the GDP is calculating on the basis of current year prices. Okay, the GDP calculating on the base of current year price is called a nominal GDP. But in the real GDP, there will have a base year. On the basis of that base year price, GDP is calculating, that is real GDP. So in the nominal GDP, the variables are measured in current dollars, but while calculating real GDP, they are taking a base year price. So the GDP deflator, it shows the ratio between nominal GDP and real GDP. So children, so in this lesson we have learned many important concepts and also equations which are related to national income accounting. So all these terms are related to each other, right? And it also seems very similar to each other. So you don't get confused while studying this topic. So you should be more attentive while learning this topic. Okay children? Okay, thank you. Stay safe. Have a nice day.